Okay, good morning, good afternoon, and good evening to everyone. If we could just do start as always with a quick audio visual check. Just make sure you can see my screen and hear me okay. If somebody could just comment and make sure that you can hear me, that'd be great. Also, please introduce yourself. Tell me where you're coming in from today, where you're dialing in from. Tell me a little bit about yourself, your trading experience. That would also be extremely helpful. But as I say, thank you very much for joining us today. Somebody, like I say, could just confirm that they can hear me okay and also see my screen. That'd be great. Um, Perfect. Thank you very much, Jamie. Thank you very much for confirming. Right. Okay. Yeah. All good stuff. So yeah, UAE, brilliant. I was there in October, actually, in Dubai and Abu Dhabi. It's a lovely part of the world. So, good stuff. Thank you very much, Mark. Thank you very much, Jennifer. Thank you very much, Conway. Good stuff. Right. Okay. So, um, today's session is going to be about market structure. If you could um, please ask questions as we go through. If I can answer it right there and then, I will do. If not, there will be some time at the end of the session for Q&A. So if I do skip over a question, I will come back to it at the end. If I do miss it, it will be a mistake, not intentional. So please, if I do miss it, I apologise, and please just ask the question again. Yes, this will be recorded, Mass. It will be recorded as and sent to you. Um, and yeah, so also if you could please stay on at the end of the session, because there will be a short survey. That survey just allows us to get some feedback from you guys, helps us improve these, and also helps us get the right topics that you require to make sure that you get the education and what you need and the value you need to help improve your trading. Okay. With that said, let's jump into the session. So as I say, for just a quick introduction to myself, if you've been on these webinars for a period of time, you will know who I am. I am the VT Markets Global Operations Strategy Lead. My role here is to provide high-level educational content for traders of all levels. So that's from beginners right the way through to experienced professional traders that are already profitable. I am a professional trader myself, and I'm also an investment manager, and I've been trading for more than 20 years now with a career. My career started in London when I left school, took me to Hong Kong, and I've been an independent trader since 2014. I'm also an award-winning trading coach and mentor, and the founder of an online trading education company called Key Zone Traders. So that's about me. And so today I want to talk about market structure. And this is really something, it's fairly simple, but I think we try it, and without it being explained, sometimes it's overcomplicated and sort of muddied a little bit. So I'm going to try and break it down to a more simple understanding, and therefore also give you some ways to identify when there's a shift or a break in market structure, and also how we use that information. Because I think a lot of people and a lot of traders, especially when they start out, they might see something, they jump into trade straight away. Breaking of structures shouldn't mean that we take the trade straight away. It should mean that we recognize that there may be a shift in the market, in the way that it is, the price action it has been currently, or in the recent past, and that we may need to change our view in terms of change our bias and the way that we approach and the direction that we approach the market going forward. So market structure is one of the basic foundations of technical analysis. Okay, it tells us the story of the market, and it helps us formulate our trading ideas. If we know what the market structure is, we know where we should be trading. It helps us establish a bias, and it tells us what direction we want to be trading with. So it tells us whether we're trending, whether we're consolidating, and what type of structure that is. You know, you can have ranges, you can have channels, you can have like trending markets. You know, there's multiple ways of identifying market structure, and it's also, once we've identified the structure in the market, we can then work out ways to identify when that structure breaks, so that we can then change our bias and change the story and the narrative around what we're looking at in the markets. Okay, so market structure. How to define market structure. As I said, the market is always communicating something to us. If it's in a clean structure, then we have a clear idea of how we need to approach the market. If it breaks that structure, it's telling us that that pattern, that market structure is potentially over, and there might be a change in price direction coming up. So we do not and should not, as I say, act on every single move. We need to help it. We need to use it to help us create the story that will determine our buyer. So again, as I said, a lot of traders, when they start out, they'll see market structure and they say, right, okay, we've got this range breakout. As soon as it breaks that range, they want to jump in and get into the market. Where in actual fact, you know, what that's telling us, if the market breaks to the upside of a range, then it's breaking out of that range and we want to be taking a more bullish bias. So rather than playing the range, we now want to be focusing on buys. So it doesn't mean to say we buy the market straight away. It just means we then know that we need to start looking for long opportunities, because the market has told us that it is now not in a range bound market and it's breaking out to the upside. So we have several tools available to us to help us define market structure. We don't need to use them all. And market structure patterns reveal how price is moving. I'm not going to cover every single way that we can look at and identify market structure, but I'm just going to go through a few of the main ones that we look at, and then you can obviously take that away. Generally speaking, the theory remains the same across any sort of type of market structure that you want to use to identify what structure the market is in. Okay, so we can use moving averages. Okay, so moving averages can often act as dynamic support and resistance, and we covered this in some basic detail when we spoke about the impulsive and corrective price action, how we can use the moving averages to determine when we're in impulsive move, and how we can use them when we're in a corrective move and a more range-bound move. Okay, so again, you can watch the recordings of the previous sessions there to go back and familiarize yourself with that. I won't go into as much detail here. But in trending markets, price will often hold pullbacks to the moving averages. And I use, generally speaking, the 20 moving average, or some sort of hybrid of this is absolutely fine. But personally, I use the 20. I know some people use the 21, the 25, you know, just something around that is absolutely fine. And generally speaking, in trending markets, price will pull back to that 20 moving average, and it will act as dynamic support or resistance. Now, if price is crossing back and forth and it's oscillating, then the moving averages will be horizontal and there'll be no clear trend. Again, you then know that you're in a more corrective structure of the market. So we can use moving average to determine if we're in an uptrend, a downtrend, or in a range. And also, we can therefore also use it when we can identify when structure is changing. We can use it to identify when structure is changing. We're going to use an example here, okay? So this is a US dollar CAD. This is a 1 hour chart. And you can notice in this uptrend here, it's a really long uptrend, but notice the pullbacks to the 20 moving average, okay? It holds the moving average here. There's no sort of close and breaks below, like small wicks, but generally speaking, it holds the 20 moving average, indicating that we are structurally in a strong uptrend. So all the time that we're holding this trading above the 20 moving averages pointing upwards, and we're holding that price action above the 20 moving average, we know structurally we're in an uptrend. Okay, so we want to be focusing on buying the market. Okay, now here very quickly we can see that price starts to break below that 20 moving average. So that is a break in structure, okay? Just by trading, by closing below and actually then trading below that 20 moving average, okay, that is a break in structure. That tells us that this trend is now coming to an end, or it's over. Okay, so straight away, just even here, we get this strong close back below. That there is a first indication that that structure is breaking, because it hasn't happened before. It's a change in the narrative of what has happened in the market. It's the first indication, okay? And the market, and also just notice that the moving average then turns horizontal. Okay, so again, it's another reason that we know that we can use the moving average to determine that structure, that upward trend structure, has broken. Okay, action is not impulsive, which indicates the initial trend is over, and we do not need to act impulsively. Okay, so just because the structure has broken doesn't necessarily mean, right, okay, we now need to short the market, we now need to sell. Okay, we just know that strong uptrend is now over, and therefore we just need to change that narrative in our minds that we're in a strong bull trend, therefore we've got to buy the market. Okay, we've identified that the structure is broken, therefore we've got to take a little bit more of a cautious stance and wait for the market to then indicate its next move, because at the moment it's in a corrective structure. At this point, we don't know whether the market would continue and break back to the upside, and therefore we can continue to look for longs, or we don't know whether the market is more of a reversal, and we need to change our bias. Okay, but we can, as soon as we get this strong impulsive close back below that moving average, that then tells us that we now need to change our bias to the sell side, because it's an impulsive and clear change in the market structure. Okay, so we can use the communication of the structure of the market to help us determine our bias. Okay, is that clear, guys, on how we can use moving averages to help us determine what structure we're in, but also to then determine when that structure might be changing and help us formulate our ideas and our trading biases? Is that all clear, guys? Please let me know if you have any questions. Thank you very much, Shunjay. Okay, now we're going to use how many candles would you say? And that's a good question, actually, Mark. So Mark says, how many candles would you say are needed before confirming break of structure? Realistically, it's one. Like you can confirm break of structure, or say confirm, but you can identify some form of break of structure with one candle. Okay, this candle here, okay, there is not a single close below that 20 moving average up until that point. So that is your initial indication that there is a break of structure. Okay, so that is that you could say that you certainly there's an indication after just one candle. And again, here, you know, this is a real confirmation of break of structure, because it's one really impulsive candle that breaks lower and sort of shows that the new structure is starting to form. Okay, so technically speaking, I guess you could say an indication could be as little as one candle, especially in a really clear and well-formed structure like this one. This is a really clear and well-formed structure of moving averages. Okay, and so therefore that one does change things. I mean, realistically, you could probably sit there and say, okay, well, this one closed back below, this one closed back above. You know, it wouldn't be impossible that this then continues, and you could say, well, that structure remains in place. If this continued higher, it doesn't. So you could probably sit there and say, after 4 or 5 candles, you're pretty much you can be pretty sure that that strong trend is over, because if that structure was going to continue even after this candle, we would get this candle breaking back above the moving average and then continuing to push higher. Okay, so and again here, you know, that is such an impulsively strong candle that, yeah, as soon as we start to see it breaking down again, so what's that, 1 2 3 4 or 5 candles again. So I think there can be an indication that the structure is broken after one. If you're waiting for real confirmation, it normally comes within sort of 4 or 5 candles. Which time frame is suitable for using the 20 moving average? I believe all time frames are okay for that, depending on your style of trading, whether you're a scalper, day trader, swing trader, depending on your time frame. But yeah, I think it's suitable for all time frames. Cooldeep asks how to use broker break. I'm not too sure what you mean by broker break, Cooldeep. If you could please expand on that, that would be great. Okay. So this is my personal favorite. Again, it doesn't mean to say it's the right or wrong way. This is just the type of uh, structure that I use in my trading, and the one that resonates with me the most, and that is support and resistance zones. So we can also use support and resistance zones to identify institutional liquidity. And quite simply, if we are trading below a zone, it is resistance, and if trading above a zone, it is support. These provide the tops and bottoms of range structures, as well as they can provide support and resistance in trending markets as well on retests. When price breaks through these zones, we know that structure has broken, and how institutions view those zones has changed. So we see it all the time. Once resistance breaks, it can turn to support, and once support breaks, it can turn resistance. Okay, so it's just structurally, again, if it's a resistance zone, if it breaks, then we can view it as support. Okay, and again, this here, we've got clear resistance. Okay, we've got two, we've got one, two, three touches, and there's reactions from all of them. A shallow one, then a really strong one, back up, another strong one, and then price breaks the structure. As soon as we see price break that structure, then it moves in that in that direction. Okay, I do believe this actually did come back and retest this and had a reaction as well. That's the sort of reaction that we would look for. But if you identify that we have now broken structure, you can then change your bias, because all the time we're looking below this this zone of resistance, really strong zone of resistance. We would have a bearish bias below, whilst we're below that or around that. As soon as we break that structure, we would then change our bias, and we would look for longs. Okay, and we return to our trading plans to look for longs. Okay, trend lines and channels. Trend lines and channels. So if you get a series of higher highs or lower lows, it can show that the market is trending or moving in that way. So these can often create trend lines and channels that become support and resistance. And a break of a well-defined trend line often indicates that the structure is changing. These, in my opinion, are a little bit more subjective in nature as well. A bit like support and resistance, although support and resistance, I feel, certainly from a horizontal point of view, is a little clearer. I believe trend lines and channels is one of the most subjective ways to look at the markets and structure. And this is a gold 4-hour chart, and you can see that we have a bearish corrective channel. Okay, so we've got the impulsive move, but then we've got this structure which says that we're in a channel and we're in a negative channel. As soon as we see price, so we've got 1, 2, 3, 4 touches, again, well-defined trend line, top trend line down of that channel. As soon as we see price break, we retest that channel, and then we push higher. Okay, so we wait, we get in this market, in this here, we are structurally in a downtrend. As soon as we break that structure, then we can go, okay, well, this channel is now broken. There potentially, again, we don't act straight away. There is potentially a change in price. Therefore, we need to be more dynamic and look for ideas and ways to maybe get long to take advantage of this next move. So again, all the time you're in this channel, you would be looking for or have a negative bias, a bearish bias. As soon as we break that structure, we're not jumping in and trading straight away. We are looking for opportunities to get long. Okay, or to change our perception of the market. So how to use, so are you, so in when you're talking about fair value gaps and how to work it, Cool Deep, are you asking how to use it in terms of break of structure, or are you asking how to use it just in general? If you're talking about break of structure, then we can cover that briefly. If you're talking about how to work in general, I feel we need to cover that in another session, just because I don't want to go too far off topic. Okay, we then have consolidation and ranges. When we're in a consolidation or range phase, we have clear support and resistance. So again, we're sort of tight. This is generally can be used with those support and resistance zone structures as well. The market is waiting and anticipating the next move in price. There are no higher highs. There's no lower lows. We're in a range-bound market. And we can often see more false breaks, liquidity grabs. So we need to work out ways to be more confident of breaks of structure with these. So we need to be much more careful with consolidation and ranges. And again here, okay, shows this is a daily gold chart, and we had this sort of consolidation range phase here where you had resistance up here and support down here. But notice there we've got one sort of spike up here, and we've got another spike down here. So it's not that we see a lot of these sort of liquidity grabs and spikes and stuff like that are not particularly clean. So we need to work out ways of identifying when market structure has broken so we can then change our opinion and our bias. We're going to cover that now in terms of how we actually classify when market structure has broken, because some people would, again, what they would sit there and see is they would go, right, okay, as soon as this price breaks this resistance level of the support, or as soon as price breaks the low of the correction, they would try and get short. So we need to try and find out ways to confirm that the structure has broken. Okay. How to trade one time, make two pattern trade, and how to face problem. Okay, Tarluk, sorry, I don't understand the question. How to trade one time, two pattern trend line. Do you mean the trade? Is that a trend line? And how to face the problem? Apologies, Tarluk. I don't. If you could please rephrase the question, I'd be more than happy to help with that one. Okay, so we're looking for disruption. Okay, disruption of a clearly defined pattern. Okay, one of the biggest things that traders do is they try and trade every single market structure, and all the time. What we actually need to do is we need to wait for the market to get well-defined structures, clean structures, and then we trade those. We need to exercise the patience to wait for well-defined structures, whether that be trending, whether that be range-bound. It doesn't matter as such. Like, you know, if you're a range-bound trader, you just need to be patient to wait for clearly defined range-bound structures. If you're a trend trader, you need to see well-defined trend structures, and then we continue to use that to determine our bias until we see something change and that structure disrupted. And that disruption is when we see any price break of a clearly defined structure, which communicates that order flow may be changing. There's a pattern, like a well-defined regular pattern that has now changed. So you can call it a change in pattern. Okay, it can be a break of support, resistance zones. It can be a break of moving averages, trend lines, and ranges. All of those examples that we've just used, you've seen a clearly defined structure, and then as soon as price breaks that structure, that is the disruption for you to sit there and say, right, now that order flow may be changing. There may be a change in the structure of the market. Therefore, I need to start remaining dynamic to potentially changing my bias. We don't need to act on disruption, as I say. We just need to be aware that the structure may be changing, and we need to remain dynamic to our future trading decisions. Okay, just a couple of questions coming in before we move on to how we determine when that structure has confirmed to be changed or to have broken. So which time frame is best for trading? Called it that. Really, there is no one particular time frame which is best. It all depends on you, your trader profile, and your strategies, and the type of trader you are. You know, some people who want to think like they can think quickly, they act quickly, and actually that helps them, because if they take longer term time frame trades, they're constantly meddling because they're constantly checking a trade and meddling. Then, you know, the best time frame to trade for that trader would be the lower time frames, because it allows them that quick, fast paced action. If somebody needs a little bit more time to formulate ideas and not act impulsively and quickly, and can't think as quickly, then they need to trade higher time frames. So there's no one particular time frame that is best for trading. It's about which one is best for you, your trader profile, your lifestyle, how you want to fit trading into your lifestyle, and that's the best time frame for you. Which one time make chart pattern and how to trade this big. Okay, so when one time make two chart pattern and how to trade. Okay, Tyler, I'm really sorry. I'm not too sure of the question there. Apologies, I can't. Yeah, so apologies. I'm not too sure of the question there. Does it mean that if the candle closes outside support or resistance, it is break of structure confirmation? Okay, Dave, that's a good question. Hopefully, what we're about to cover in terms of acceptance, we'll clarify that so in much more detail. So let's go through this part, and if you've still got questions, then we can come back to that one. What's the best tip for avoiding market manipulation, fake outs, and stop loss hunts? Again, Krishna, hopefully this section of the presentation will help with that. And so again, if you've got any questions after this, then please do let us know. At what time usually best to trade? Again, Jennifer. So sort of depends on your strategy. The most volatility is around market open and market close. Okay, so indices would be sort of, and generally speaking, for Forex and commodities, this sort of aligns as well. So like London Open, London Session Open is sort of around sort of 7, 8 o'clock in the morning UK time. US Open is around sort of 2:30 sort of UK time. So it's sort of like usually around those market opens or market close times for indices. That's when the highest volatility comes, and that does lead on to it's sort of, or should I say, session open. So London session, not necessarily like FTSE open or DAX open. It just which ties in with the London session. It's the London and the London session open, which, as I say, is normally around 7, 8 o'clock. US session open, and then the Asian session open as well. So those are the times when there's most volatility. And that's probably when it's best to, or when there's more opportunities to trade. That doesn't mean to say that you can't trade at other times. You know, there can be volatility around news events, which can create opportunity. You know, if you're a swing trader, like trading off the daily time frame and Forex, then actually you want to be trading around sort of 10, 10:30 at night in the UK time. Again, using UK time, that's just because where I'm based, because that's when that daily candle closes. And you have the rollover and the crossover, so that's when the most information is available to you for that. So it's sort of, again, unfortunately depends on your time frame and stuff like that. But if you're looking as a day trader for more volatility, then I would sit there and say it's around those session open times. Change of character, break of structure. What's the difference? There isn't really, John. They're just different ways of calling it. There's just different names. There's not really a massive difference between change of character and break of structure. Okay, we're going off topic a little bit here, guys. So I just want to get back onto the presentation. Okay, cool. Right, acceptance. Now, one of the most difficult decisions a trader faces was when that structure, how we see confirmation that that structure has broken. We can often see false breaks, liquidity grabs that trap traders and get them on the wrong side. So this going to that question that you had, Krishna, about avoiding manipulation and fake outs. Okay, so we need to identify ways where we can say confidently that a structure has broken so that we can adjust our bias if needed. And one way we can do this is what I call acceptance. Okay, there are different types of acceptance depending on how aggressive you want to be, and we're going to cover sort of 3 of those types of acceptance now. Okay. Okay, Tyler. Okay, Fibonacci. I'm more than happy to run another session, different session on Fibonacci. Today's session is all about break of structure. So, but I'm more than happy to put a presentation together in another session about Fibonacci and how to use that within trading. So close and break acceptance. Okay, this is the most aggressive form of acceptance, and it can still carry a higher risk of getting you trapped and into a false break. Okay. We need a clearly defined structure, as always. It's going to be the same with everything. I think we always need clearly defined structure to be able to trade, because that is what's going to give us the best and most high probability trade setups. Now, when price closes above or below the structure and then subsequently breaks the candle in the direction of the move, we have our close and break acceptance. Okay, and this ideally we want to see like an impulsive move through the structure as that confirmation. If it's sort of like a little bit more corrective or a little more indecisive, like with wicks on show, it just shows that that's not a really clean confirmed sort of clear break. We want to see like an impulsive move closing in that sort of like top 50% of the candle, or closing in the bottom 50% of the candle, to show that the momentum is with that move. And a corrective retest of breakout areas of broken structure often gives entry opportunities. So going back to one of the examples that we had, okay, we've got a clearly defined resistance, okay, clearly defined resistance level, resistance zone here, okay. We then we need to wait. You see this first candle here? Notice that it's very indecisive. It does not close above that resistance zone. So even though that candle is there, we haven't got any form of acceptance at the moment, because it could potentially just be a liquidity grab. It could just be a stop hunt, a false break. Maybe the zone is slightly off. But at that time, I do not change my opinion on the structure of that market. Okay. This candle, strong candle, okay, it's quite a big candle. Doesn't quite close right at the top, but it's certainly in the sort of top about 25%. But it closes clearly, a clearly strong close above that resistance, okay? Price then breaks that higher high, confirming that price is comfortable above that zone now. So it is saying that, you know, not like here where it's like, I've had a little go above it and now I'm not too sure. It's like, okay, strong candle, close above it, and I'm still happy to push higher, okay? So that is your confirmation and your acceptance that this zone or this structurally has now broken, okay? And you can therefore change your bias, okay? So it's like an acceptance, it's your confirmation of the change, or of the break in structure, okay? And again, that doesn't to sit there and say that 100% of the time this is just going to carry on and do what this market does. You know, sometimes you might get this candle open and then bosh straight back down. Like if there's some news out or something like that, you could see a false break. And because you're only really basing this on one or two candles of information, you are still susceptible a little bit more to those false breaks. But this would be the most aggressive form of acceptance, to sit there and say, you know, we've got acceptance above that structure and that structure has broken. Another form of acceptance is your swing, what I call swing acceptance, okay? And this one is less aggressive than the close and break. It's probably my least favorite, because you end up missing a lot of trading opportunities. And it can often, it's a little bit more ambiguous as well. Like it's not as clearly defined. So it's probably my least favorite. But again, we need to see a clearly defined structure. We need to wait for price to break that structure and create a swing high or a swing low, either just above the resistance of the structure or just below the support of the structure. And then we have that as our reference point, okay? And then if we subsequently make a higher high or a lower low, again, the market is indicating that it is comfortable outside of the previous structure, and therefore we have our break. And again, it just gives, rather than looking at one or two candlesticks of information, you're allowing the market to develop a price above the resistance or below the support, take some breathing time to create that swing level, and then if it continues, then it's really confirming that it's happy above those levels or below those levels, and confirming that the structure is broken. If it's not clearly formed, there is a higher risk of getting chopped in and out of trades as well. So if the market structure is not clearly well formed and you're in this sort of choppy sort of price action, then you're going to get chopped in and out. So this one is probably even more key, that we have really cleanly defined structures as well. And again, we're going to use the gold situation from before. The gold chart from before. We've got this clearly defined downward channel resistance here. We break price, we develop a swing high, okay? So basically we have a bearish corrective channel, price breaks the channel, creates the swing high. If it was a false break, this candle here would go back inside the channel, and then it would just continue to form downwards, okay? But notice again here, okay, so if you was looking at close and break acceptance, okay, oops, excuse me, sorry. you would actually have your acceptance here. You could therefore look for opportunities to get long. You might get long on the retest of this trend line channel because, again, resistance broken, we can use it as support. But by waiting for that confirmation of swing acceptance, okay, when price breaks the swing, that swing high makes a new high over here. Again, this one is not a clear break of the, although it makes a higher high, we want to see this really strong close back above that swing high. So it would be this candle where we therefore have swing acceptance, and we can then confirm the break of price structure. And again, you've still got plenty of time here to change your bias and look to try and get long in this sort of trend here. But that is therefore, again, you're basing your information on how many candles is that? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So 10, 11 candles. So again, it's just taking more information from the charts. It's exercising more patience. But a lot of the time, you can actually, by the time this is developed, you know, you may have missed opportunities or something. So it's my least favorite, but it can be quite strong and quite a good way of confirming acceptance when we see these sort of really like the swing highs and lows created just outside the resistance or support, like it is in this case. Okay, but if you're waiting for that acceptance, you miss out quite often on these retest opportunities. Okay. Where would you typically mark the top and bottom of the support resistance zone? It's where, again, so Jamie, that's we have covered that in a previous session. So maybe look at the recordings of previous sessions to how to really classify support and resistance zones. But it's looking for multiple touches and strong reactions from the similar areas. Okay, so again, if I'll just quickly go back before we move on. This one here, we've got multiple touches, strong reaction, multiple touches, strong reaction. That's how you mark tops and bottoms of support and resistance zones, or that's how you identify support and resistance zones. In terms of the width of zones, again, going a bit off topic, but I personally use a volatility indicator called the average true range. And it's like using that to adjust the zones again. So the team have kindly posted there where you can find previous recordings. Go back and watch that support and resistance zones webinar, and that will explain it in much more detail than I can go into right now because we're trying to stay on topic here. Okay. We then have full acceptance. And this is probably my personal favorite. It's the one that is still fairly aggressive, but it is waiting for that more confirmation. So it occurs when there's a full candle, both the body and the wick closes beyond the structure. Okay, it signals that price is comfortable holding above or below that structure with no rejection back inside, and then a break of that candle confirms the market wants to continue in the direction of the breakout. Okay. Generally speaking, if we see false breaks, market traps, not all the time, this is not the case all the time, but generally speaking, once we see the break in structure, price doesn't stay there for too long before it rejects and goes back inside the structure. So by waiting for this full candle to close above the structure or below the structure, it allows price to really confirm to us that, you know, it doesn't need to quickly return back inside the structure. It's there, it's happy, it's comfortable trading outside of that structure, and therefore the order flow may have changed outside of that structure. So we can then adjust our directional bias to fall in line with the new information the market has given us. And again, notice I keep mentioning that we wait, like just we see the confirmation and then we use that to change our bias. We're not just right, we've seen the change in structure or the break of structure, therefore we've got to trade. It's just helping us form our future trading decisions. And again, going back to the original, the Nasdaq one, on the close and break, we would have it here, but on the full acceptance structure break, it would actually be on the next candle. So we see the full candle body and wick. So notice that the bottom of this candle is inside the zone, so it's not full acceptance. The full acceptance comes here where the low, the high, the body, the whole candle is above that zone of resistance. And then once price makes a slightly higher high, which it does here, or certainly up here, we now have our full acceptance, and we can go, right, okay, we want to get long. So we want to look for trending opportunities, like to get long into this trend, or we wait for pullbacks to get long onto this zone and retest of this zone of support, resistance that is now support. And we can actually use this in terms of when we talk about higher time frame correlation, higher like multi-time frame analysis. If this is a 4-hour chart, okay, so if you see a break of structure on the 4-hour chart, you can actually use, and you trade like a 15-minute chart or hourly chart, you can then use that to formulate your trading ideas on your lower time frame. So you see the break of structure, and like I say, it doesn't necessarily mean you need to act upon it, but it's like, okay, well, I'm a 1-hour chart trader, okay, so if I see a break of structure on a higher time frame, whether that be the 4-hour or the daily, I can then go, okay, well, I execute off the hourly, but I've seen a break of structure on the higher time frame. Therefore, I need to change my bias, and I need to look for opportunities on my lower time frame execution chart to form with that break of structure and that new information. Okay, does that make sense? So it's not overcomplicating the process by looking at multiple different time frames. It's like, okay, higher time frame says break of structure, therefore I need to change my bias on my execution lower time frame. And again, that could be if you're a trader on a 5-minute chart, you want to look for a break of structure on like an hourly chart to then fall back and change your bias on your execution on the 5-minute. Okay, guys, does that all make sense in terms of break of structure, how to confirm break of structure, and ways that we can look to do that? Is that all clear, guys? Any questions on that? Like I say, well, if what we'll do, we've got about 15 minutes, so I want to get through the rest of this material here, and then we'll come back and try and answer some of those questions that are not specifically related to this session. And like I say, if we miss any, I'm more than happy to create other sessions focused on the topics like fair value gaps, Fibonacci's, and stuff like that. Okay. Any questions, please fire away. Other than that, I want to talk about changing pattern or shift in momentum. Like, they're both the same thing. Okay. You mentioned change. I know it's like I think it's a smart money concept or terminology like change of character, chock, I think they call it, or something like that. And that's sort of like your breaking structure. This is something slightly different. This is everyone's heard of an engulfing bar. Okay, so this is called a changing pattern or shift in momentum. And we want to look for changing patterns, even if the structure itself is not broken. It's like this is something that I find very powerful, and again, in terms of communicating order flow to me. Now, I'm sure there's I'm going to presume here, but if anyone doesn't know what an engulfing bar is, please let me know. But I would presume that everyone knows what an engulfing bar is. If you don't, please just post, and I will let you know what an engulfing bar is. But the problem with an engulfing bar is it gives information based on 2 candles of data. Okay, Simon. So an engulfing bar is where one candle completely eclipses the price action of the previous candle. Okay, and I will actually show you this in more detail in a moment. Okay, as an example. But basically, what it's saying is that you've got one candle's worth of data. The next candle, the high is higher, the low is lower. It's just like the candle completely eclipses that previous candle. Generally speaking, it's supposed to show a change in direction. It's because it's like a big shift in the momentum. Okay. Personally, I don't like one engulfing candle. Okay, because it could just be the volatility on the previous session was so low that it doesn't really create a really big shift in momentum. It's just that previous session the volatility was low, this session it's back to normal, and it doesn't really give a big picture, an overall picture of the market. So I'm not massively keen in terms of just looking at one engulfing bar. A change in pattern or shift in momentum, as I call it, is much more powerful as it creates a lot more context and demonstrates an undeniable shift in the order flow in the market. Again, we use it as information to base future trading decisions. And again, if I see this, I generally use this for myself if I see it on a higher time frame. So again, if I'm changing on the if I'm executing, I generally execute on the hourly time frame these days. So if I see one of these shifting momentums on like a 4 hour or daily, I'm like, right, okay. If I trade that instrument, I'm like, okay, need to allow that to help me formulate my trading decisions on my hourly time frame chart going forward. Okay. So the characteristics of a shift in momentum, and I'm gonna show you this in a chart. Okay, it's an engulfing bar that engulfs several candles beforehand. Okay, and you want to see at least 3 to 5 candles, but generally speaking, it can be a lot more. I've seen like one candle engulf like 30, 40 bars of price action, and those are really powerful signals because it just shows you that there's a huge shift in the momentum. Price may have been ranging for a period of time, and then one candle completely eclipses that order flow. And you know, a lot of these shift in momentum patterns happen on some form of news, or you know, on some form of data release or big market event or something like that. But it just really, it communicates to you how the market sees that event, and therefore how you need to react to it going forward. Okay. It can form at the end of a trend because the opposite side is stepping in aggressively. And as I say, if we see it on a higher time frame, we then transform that down into our execution time frames to formulate our trading decisions. If we are already in a trade and we see these shifting momentums, then you can do it to, you either use it to tighten your risk, maybe move stock to entry, or reduce risk because the market's against you. Or if actually, you know, you see you're in a trade, you start pulling back, and then you see this move in the direction of your trade, that's great because that is like, okay, the momentum is still with me. I can continue to hold and extend profit, and potentially even hold for higher profit targets. Okay. So here we have an engulfing bar. So let me just try and see if I can identify another engulfing bar here. Okay, so Simon, just here. Okay, so we've got this candle here. Notice how this one candle engulfs the previous. It actually engulfs sort of 2 candles, but the previous. Here you go. Here's a perfect one. Here's a perfect one. Okay, one candle. This candle then engulfs top to bottom, but it only engulfs sort of three candles. It doesn't break, okay? So it doesn't therefore continue and confirm that engulfing bar. Carries on. We've got one with this price action here, higher high, lower low, engulfs sort of two candles. That one does carry on higher. Notice how this is the one where I'm like, right, okay, this is a shift in momentum again, where we've got a double top, so we're at resistance. We've got a strong trend. We pull back, get the double top, and then bang, really strong candle. This doesn't just engulf one candle. This engulfs 10 previous candles, okay? Not just 1 or 2. It's 10 previous candles. And there we then see the follow through for this. So this is the hourly time frame. So if you saw this on the hourly time frame, you would therefore adjust your bias on the lower time frame, like a 5 minute, and you would have 1, 2, 3, 4 hours of solid selling pressure where the market it would be very difficult to take a short trade in that 4 hour period and have a losing trade, okay? Because you can see that the momentum is just with you. So again, it just shows you a much more powerful piece of information, okay? It's not just 1 or 2 candles, it's like multiple candles. It's really showing that, like, you know, 10 hours of trading, 10 hours of data is just like eclipsed in one session. It's really powerful show of force of a change in the order flow. Okay, and then just another example. This is actually a weekly GBP US dollar, and again, this is just to go to show that it generally happens on like events and stuff like that. But although it does happen on events, it allows us to identify how the market sees that event, and that is the communication that we need to then formulate our decisions after the event going forward. This was Brexit. And notice that 1 week price action eclipsed 25 weeks of previous price action. So in 1 week, it gave us more information than it did in the previous 6 months of price action. Okay, so it's a really powerful tool to allow us to then look at price action going forward to say, okay, we now need to confirm our bias. Okay, we know which way we need to be trading with the market. Okay, so does that make sense, people? How it's not an engulfing bar, or it's not just an engulfing bar, should I say? It's a hugely powerful tool to show market communication and how we need to form our future trading system. So again, it's not quite about structure as such, but it's I think it sort of it is that changing pattern. It is changing what the market has done previously, and I think it's a really powerful tool, which is why I included it in this session. Okay, guys, any questions on that? Like I said, we've got sort of 5 minutes or so. Oh, sorry, I've got one last slide. Sorry, how to react to breaks of structure. And this is really just reinforcing exactly what I've been saying, repeating throughout this session. Most traders see break of structure and react by jumping straight into a trade. They fear they are missing out on the next big move. So they see the break of structure like, right, okay, the market's changing. I need to get into that at the bottom and I need to take advantage of the whole move. But we need to use the break of structure as information to formulate and trading decisions. We do not need to enter a trade every time we see a break of structure, okay? Okay, so you can earn a referral. Please scan that QR code. You can, if you refer someone to VT Markets, you can earn $200 per referral, and they get a 50% bonus on their first deposit as well. So please, if you know anyone that is trading, would like to trade, please recommend them to VT Markets. Use that scan, pass them that link, and therefore you get the $200 reward, and they get a 50% bonus on their first deposit as well. Okay, so that is the end of the session. I'll leave that QR code up there for you as well, just while we try and that's how we can. Sorry, lost my train of thought there. Yeah, so hopefully you found that useful. Please do stay on to answer the survey, but let's go back and answer some of these questions that we have. Okay. Okay, which session is best for trading? Again, there's no real session that I would say is best for trading called it. Again, it depends on what time frame you're in. It depends what markets you're trading. Okay, so obviously, if you're trading indices, then the best session is whichever session that index is in. If you're trading Forex, then generally speaking, London is where there's most volatility. That's where the majority is traded. New York is also very good and very liquid. But again, it might also depend on which currencies you're trading. Aussie dollar, New Zealand dollar would be more influenced in the Asian session, maybe, because that's when the news releases are out that are going to impact it the most. So yeah, again, it probably depends roughly on what you're trading and stuff as well. Okay. The team have kindly posted there to links to sign up for the next webinar. So please use that to register. That's going to be on the 16th of December. Really looking forward to that one. That is going to be myself and a colleague of ours based in Mexico, and we're going to talk about how different traders, we've had different journeys, but how we see the same market from different angles. Okay, so hopefully it will give some insight into how people look at things differently, but how actually sometimes even though we look at the market very differently, there are still some similarities and consistencies there. So really looking forward to that one. There's a link to open a live trade account with VT Markets, another link for the referral program there, and you can sign up to webinar updates and also join our Telegram channel as well. Cool, good stuff. Is there any questions that I have missed? Guys, please do fire them back in there. We are, as I say, the survey I believe is going to come up in a couple of minutes' time. So please do stay on. Let's have a quick look, make sure that I see if I have missed any questions. What sort of trade volume? What sort of trade volume, lot size are the big players, banks trading gold at roughly? You know, yeah, it would vary, but they're trading everything in size that is on such a scale. And to be honest with you, a lot of the big tickets, they're generally probably still done OTC rather than on exchange. So whilst you might see some volume go through some larger lot size, they'll be doing a lot more, a lot bigger size off screen, and that can go into yeah, like big numbers basically. Okay. Um, Okay, any other questions, guys? Please do fire away. As I say, otherwise we've got a couple of minutes. But yeah, hopefully, if you hopefully you've seen now that how we can look and confirm structure and when it's in place, but also how we can look and confirm when that structure has broken, and then how we use it to formulate trading decisions. Again, I think that's the key message that I want to try and get across, is that we use these it's a communication. It's not a trading strategy. Okay, they're not trading triggers. It's a yeah, it's using it as a market communication tool to help formulate our future trading decisions. So please advise on what timeframes for consistency in profits. Again, Emmanuel, I mean, somebody asked this earlier on in terms of what is the best time frame to trade. It really depends on you and your trader profile. So, if you um, need time, excuse me, to formulate trading ideas, or you can't be at the screen for long periods of time, you need to trade higher time frames to get consistency in profits, because otherwise you're not going to be able to execute your edge. If you need to think quickly and react quickly to the markets, because if your trade goes on for too long, you start meddling with it and you start changing it and you adjust and bend your rules, then you need to trade lower time frames. So it's not about one particular time frame. Like you shouldn't be looking at it in that way for consistency and profits. It's like, it's not about the time frame. It's about getting your processes right and your strategy right to get the consistency in profits. Okay, so it's about understanding yourself as a trader, and then developing your trading plan and edge around that. That is what's going to get you consistency in profits. Don't Otherwise you're searching for this sort of holy grail thing which doesn't exist. It's about getting the process right, getting your edge and structure right of your trade plan, that suits you and your trader profile. That is what's going to bring consistency and profits, not one particular time frame. There are successful traders that I know trade off like tick charts and 1 minute charts. Personally, I find it too quick. And there are others that trade off daily, weekly, monthly time frames, and they all have consistency and profits. It's just that's what works for them. Again, you've heard people say lower time frames are too much risk and higher time frames much better. It's just because there's less trades to take. So of course there's less risk involved in higher time frame trades, because you take less trades. So over a period of time, you naturally have less trades, you have less risk, which is why you should adjust your risk depending on the time frame that you trade as well. Anyway, so I don't believe that. I believe it's just about the processes rather than a particular time frame being too much or not. Okay, guys, right. We are going to wrap up the session now. I believe that we should get the survey link. Thank you very much for joining us. And please do stay on and answer that survey. It would be much appreciated. And look forward to seeing you all next time. Thank you.